name is Melissa Raylander and I'm the Queensland Regional Distribution Manager for Pengana. As most of you on the call would be aware, PE1 is a custom-designed private equity portfolio which we've purposely built for Australian retail clients. We've been able to offer liquidity to an otherwise illiquid asset class without compromising the underlying investments. GC and Grosvenor are the underlying investment managers for PE1, and I'm delighted to have Fred Pollock, who is the CIO for GCM and portfolio manager for PE1, and Corey Lopretti, who leads portfolio construction on the vehicle, presenting today. Fred's going to take us through a bit of an overview of the private equity landscape, and Corey will do a deep dive into the PE1 portfolio. The presentation will run for about 25 to 30 minutes. There will be time for Q&A at the end, so please do pop any questions you have around private equity, the landscape, or PE1 in the question box at the bottom of your screen. And with that, over to you, Fred.
Hello, everybody. Thank you for taking time. As Melissa mentioned, my name is Fred Pollock. I serve as the Chief Investment Officer for GC Grosvenor, and also am the Portfolio Manager for the PE1 Trust. My comments are going to be centered mostly around the market, kind of some macro environment, what's going on in private equity. And then, as Melissa said, Corey will go deeper into the portfolio, and then we'll both join together and answer your questions towards the end. Starting on slide 4, the first thing I want to mention, market so far this year has basically been risk on. So, different parts of the markets were obviously poor late in 2021 and certainly in 2022. You can see that in the slide on the right-hand column, that 2022 was a difficult period for the broader markets, but in particular for things like technology, communication services, consumer discretionary, and real estate. What you'll notice from the slide, so far in 2023, there's been some recovery. Now, percentages obviously don't work evenly. So when something like communication services loses 40% and gains back 21, it actually hasn't even gained back half of its losses. It's sort of recovered about 40% of its losses in that case. So, a lot of these sectors still have a long way to go to recover fully, and probably will not recover fully on a relative basis because of change in interest rates and growth multiples more than anything else. But I think it's an interesting observation that so far this year, markets have been pretty benign for equities, and they've been relatively generous to those categories that were affected most in 2021 and 2022. If we go to the next slide, Corey. The other thing I want to mention, so there's been a lot of turmoil in the markets from interest rate increases. So the US Central Bank, Europe, obviously Australia as well, and many other markets, you've had central banks begin a tightening cycle. I think the US is probably farthest along in that process with interest rates, short-term interest rates in the 4 to 5% range, with the kind of forward curve inverting, meaning interest rates are, at this point, short-term interest rates are in excess of long-term interest rates in a forward curve, which means that markets think that we're in a restrictive setting vis-a-vis those longer-term rates. There's a challenge in the markets, and you'll see it on the left-hand part of the slide, which is people are not sure yet whether or not the Fed or other central banks will be in a position to cut rates later this year as they had previously anticipated. So, if you went back 6 months, everyone thought we were in a tightening cycle, interest rates are going up. Earlier this year, things started to break, particularly in the banking sector in the US. You've started to have regional banks fail and go into receivership and require either government intervention or an intermediated process of selling them to stronger banks. That continues today. We actually worked on an emergency transaction over the weekend for a bank that's about to go into receivership. So I can tell you this, that hasn't, that crisis hasn't passed. It's going to continue to kind of affect the markets. It's causing a slowdown in lending, causing a slowdown in credit creation in the US. And for a lot of important reasons, the decline of these regional banks, I think, will be significant. One of them is the lending relationships themselves don't transfer that easily. So the deposits don't go away, right? The deposits move from a regional bank to, say, what is called a systemically important bank, like Citibank or Wells Fargo or JP Morgan. But the lending relationships don't move. If you're a bank in Utah and you go into receivership and most of your clients were medium-sized businesses in Utah, it's not like the deposits going to Citibank meant that all of a sudden there were relationships from lending from Citibank to those Utah businesses. There's a break in the channel, and you're starting to see that in the data. What that's meant is the market has started to speculate the last couple of months about when interest rates will stop being raised, when they might go down. I will tell you, inflation data, though, is not supportive of a cutting of the rates. Inflation data would suggest that the Fed needs to hold rates where they are through year end. And so the market is actually caught in a pretty significant turmoil in terms of figuring out where that trend will be. And so that where that tightening will ultimately land, and then also when there might be some relief, at least in the near term, for rates to go back to, I don't think anyone anticipates zero, by the way, but go back to sort of 3% or something more normal, in the context of recent history in interest rate policy. If we go to the next slide, Corey. Why does this matter? It's been a very challenging period for risk assets as a result of this tightening. So, you'll see a couple different things, which is you've got inverted yield curve, which is generally not good for risk assets. You've got equity risk premiums that are kind of at decade lows in the marketplace. You've got widening credit spreads in high yield, meaning so you have the base rate that's up, but you also have the spread, the charge on top of that to justify the risk of a credit at the same time. And I'll tell you, not in the data is just covenants are now much more meaningful in the context of debt. It's led us to be interested in doing a lot of private credit, even for the trust. And it's made it a little more difficult to borrow to finance transaction. You've seen a number of private equity deals that got signed, which then did not close because they couldn't achieve the financing that they had anticipated to do the transaction. So they've had to walk away from that. That's happened in a number of contexts. If we go and Corey to the next slide. This is the activity slide. So when I say that credit conditions are tighter, asset markets are under a little bit of stress, what it's led to is a pretty significant slowdown in global leverage buyout activity. Leverage buyout activity being kind of one of the principal or core segments of the private equity market. You'll see here from 2021 to 2022, about a 19% slowdown in North America PE invested capital. In Europe, about a 47% slowdown. In Asia, about a 19% slowdown. You'll then see some messy data in terms of kind of Q4 trends versus the prior quarter. But I think the big story here is in terms of transactions getting done, new acquisitions of private equity enterprises, as well as realizations of existing positions in people's portfolios. There's been a very meaningful slowdown in that activity over the course of the last kind of 12 to 18 months. And that continues. So if you looked at most of 2023, I think a little bit of pickup in activity, but not substantial. It's still lower than what you would have observed in 2021, which was pretty close to a record in terms of activity, to be honest. So some of this is returning to normal and some of the froth coming off in the markets. Some of it is a kind of a step down in terms of the number of deals being completed as well as the dollar volume of deals being completed. If we go on to the next slide, Corey. Here's IPO and M&A activity. So kind of corollaries of some of the key criteria for exits. Now, not everything obviously exits in an IPO, but a lot of things do exit in a merger and acquisition or a strategic sale. So one of these different venues, you'll see, global initial public offering activity is about as low as you have seen in modern history. So you had to go back pretty far to kind of the 1999 to 2001 post tech wreck period to find IPO activity in terms of number of deals and dollar volume that is this muted. And then in terms of global M&A, you can see really what's happened is we've kind of returned to a pretty comparable number of transactions and dollar volume that you would have seen before the COVID period from 2020 to 2021. So you're returning to normal, and 2023 is a little lower than 2022 at this point. So, in terms of the trends. So I think you're going to see a year that looks more typical like 2017 or 2018 for the remainder of this year. It's enough to have exits, but slower than it had been and in kind of the frenetic period that you saw in 2021. If we go to the next slide, Corey. What does this mean for private equity? It means you have fewer deals getting done. You have fewer realizations. So less turnover in the portfolio in terms of existing positions. The opportunity set is better, right? Probably than it's been in 10 years, but it means existing portfolios is not as much movement in terms of the assets. If you look here, there's kind of two indices that people broadly track. One is the Burgess North American Buyout Index, which you see on the left. So think of this as a value or a price index, much like the ASX 200 or the S&P 500, trying to track the value of private equity enterprises overall. It's not a perfect indicator, but it's a pretty good indicator. And what you'll see, you've had flat valuations now for coming on 2 years. And then if you look, and which in the context of models where people have IRRs and cash generated in these businesses and capital reinvested of typically 15% plus per year, that's actually a pretty significant statement that it'd be flat for that period of time, because the underlying kind of cash flow from the businesses and economics built in the businesses has been material during that period. So it means multiples have come down, in those assets to earn their way into that valuation. And then on the right-hand side, you'll see the Burgess North America Growth Capital Index. This is more exposed to late-stage venture, and then obviously the growth stage of capital provision before you would become a mature business and be suitable for a private equity buyer. Here, you see a much more significant decline in value. And I think if you looked at 2023, you'd see even more significant declines compounding on that, whereas you would see the private equity index continuing to sort of tread water where it is, with multiples coming in, but cash flow at the enterprise is continuing to grow to offset it, to have kind of flat valuations over this period. Corey, if you could go to the next slide. A couple key themes I want to talk about, just in terms of what's going on. We obviously in PE1 have two types of investments, and some are deals, co-investment deals in particular, as well as funds, diversified pools of assets. We can acquire those funds either in a primary context or in a secondary context, bought on market at a discount. Three areas, which I won't go into great detail, but I'll just note here, that are most ripe for us in terms of transactions today, and we're probably doing most of our activity. Continue to provide capital to sector specialists who understand their area or their niche. We're looking mostly at places where there's resiliency to economic decline. We're looking for sponsors who have been through the cycle and are tested through the cycle, so that they'll be able to successfully manage these enterprises through what we think could be a very difficult period to come. The second, structural alpha. There are a number of different ways in which you can engage in these transactions, in terms of buying at discounts, in terms of finding embedded value or innovations essentially in the deal-making process to get favorable economics for the trust. We do that regularly in terms of the way that we're engaging right now. And it can be all sorts of things, secondaries to the structure in which a security is actually offered to a company that isn't pure equity. And then the last one, which is operational complexity and special situations. So as there becomes distress in the marketplace, it's probably the right way to think about this. Portfolio companies and funds are able to engage and activate on those situations. And generally speaking, there sometimes can become a pretty big disconnect between intrinsic value and what the value of an enterprise will trade at if the capital structure is wrong, if the owner themselves has maybe got no lack of alignment because their equity isn't worth very much, but there's value in the enterprise nonetheless, and in the capital structure, and lenders don't want to manage the company. There's just a lot to do in that area, and we are very active participants in kind of complex and special situations today. This is all a little bit, in some ways, similar in the case of sector specialists. We've always been interested in that, and we obviously were talking about that before. You've really had the difficult period right now, which is part of the reason why the trust continues to perform. We were kind of prepared for that. The other two, structural alpha and operational complexity in special situations, these are points of emphasis that maybe you wouldn't have seen 2 years ago or 3 years ago. I think these opportunities are relatively new in the market. If we go to the next slide, we'll talk about kind of the key themes that we see inside deals, which in co-investment. So information technology. So this space was obviously significantly impacted from a valuation perspective in 2021 and 2022. We've been able to take advantage of that in some cases and are benefiting a little bit from the recovery that you've seen in 2023. The US healthcare space, the second one, it's a good time to be in a space that demonstrates pretty significant economic resiliency. Healthcare in the US happens to be one of those, particularly if it's embedded in the structural system with the US government or state governments as the payors on behalf of individuals. And particularly if you're in the part of the healthcare value chain where you're helping to take costs out of the system, because everyone's a beneficiary, meaning the taxpayers who are ultimately funding those payors, as well as the participant receiving the health care, as well as the provider sort of being more, everyone benefits. And so you being on that part of a secular trend, I think is a good thing. And then the last one, consumer staples. We're very interested in enterprises that demonstrate less cyclicality over the next couple of years. And so consumer staples fit the bill pretty well. It's also been a space where the multiples have come down over the last 10 years. And so there's a lot of opportunity versus some of the spaces that were maybe more attractive to people during this period of time. And so spending a lot of time there. The one place I'd mentioned, there's a lot of family and founder-owned businesses that need to change hands in that space as people are trying to do multi-generational capital planning. And so, that's an area of interest and excitement for us in terms of the trust. With that, I'm going to turn it to Corey on slide 12 to dive in a little bit in terms of the current portfolio allocation and portfolio, and then I'll come back on with Corey for questions. Corey?
So slide 12 provides a high-level overview of PE1's current portfolio allocations. PE1 is fully committed with exposure to 90 funds and over 500 companies with vintage years dating from 2003 to 2023. We've successfully achieved the broad portfolio diversification that we were targeting when we launched PE1 4 years ago and had a stated goal of reaching our steady state, fully invested and well-diversified portfolio within 4 years. We've committed at this point more than $490 million to investments, nearly 60% of which has been funded, and we have seen meaningful distributions from those investments, with PE1 having received nearly $75 million in proceeds from its investments to date. If you drill down into the portfolio a bit, we've invested in 15 primary private equity funds, and the portfolio currently has exposure to 120 co-investments and directs and 22 secondary transactions. And those secondaries are providing exposure to around 300 different companies and giving the portfolio the significant backward vintage year diversification. We saw it when we launched this, which is an important portfolio diversifier and a risk mitigation tool. If you look at the current portfolio mix, you can see that our equity co-investments and direct sleeve continues to be the largest portion of the portfolio at 55%, which is by design and where it was when we had our last webinar. But you will also see that the equity funds portion of the portfolio, which contains our primary and secondary fund investments, continues to grow as our primary fund managers deploy the capital we committed to them over their 3 to 5 year investment periods, and we execute on more secondary transactions. And as Fred mentioned, we're also excited about the opportunities we are seeing in private credit and have already executed 10 senior credit investments that are benefiting nicely from the rising rate environment we are in. So now that the portfolio is fully built out, we are going to start producing information like you see on slide 13, which shows you more specifically the type of exposure in the P1 portfolio. From a sub-strategy perspective, you can see that more than half of the overall portfolio is comprised of leveraged buyout investments, with 2/3 of that buyout exposure in the middle market. As a reminder, we focus on the middle market because the funds who operate in that space tend to compete less with larger market participants, which frequently results in lower purchase price entry multiples. They typically use less leverage, which, as Fred mentioned, is harder to get in the current environment. They frequently enjoy higher deal volume, and they have more liquidity options than their larger counterparts since they're not reliant on the IPO markets. And in the end, maybe most importantly, middle market buyout returns over time tend to be better when compared to those generated by investments in the larger end of the market. You can also see that we have some exposure to growth within the portfolio, both directly or, where possible, through investments that included structural elements designed to enhance the performance profile. These elements typically include a component of potential downside protection through the use of a variety of different instruments and terms, including things like preferred equity and liquidation preferences. And as you can also see, we have no venture capital investments in the portfolio. Geographically, the fund is 80% invested in North America and has some more limited allocations to Europe and Asia. This is generally in line with our targets, though I could see the European exposure inching up a little bit if and when market and geopolitical conditions in the region improve. And from an industry perspective, the portfolio is quite diversified, with IT making up the largest portion at 21% and several other industries, including healthcare, industrials, and financials, each comprising over 10% of the portfolio. So I'm going to use this slide to talk about the different sleeves and really provide an update on performance on some of our recent activity. So just as a reminder, there are 2 different tools we are currently using to execute equity co's and directs for the PE1 portfolio, our multi-asset class or MAC funds and our co-investment opportunities funds. PE1 has $185 million in commitments to our multi-asset class strategy, which is designed to mine the most compelling risk-adjusted return opportunities from anywhere they may come in the GCM platform. It's entirely opportunistic, which allows us to be quite tactical in markets like today that are continued to be volatile and uncertain. MAC2 is fully invested and has generated a diversified return stream across individual investments, asset classes, and sectors. While a number of positions in the MAC2 portfolio were impacted by declines in public market comps, the diversification within the portfolio has helped enable the fund to generate a very nice 1.6 times net multiple and a 17% net IRR to PE1 through the end of April. Realizations have begun to ramp up in the portfolio, with 2 distributions over the last 6 months that have brought total distribution to investors from MAC2 to 10% of invested capital. We believe the fundamentals of most of the businesses in the MAC portfolio remain strong, and believe that MAC2 is on pace to exceed its performance targets, which were a 1.8 to 2 times net multiple and a mid to high net teens IRR, when all is said and done. Additionally, despite the more challenging IPO market we've been experiencing, we believe that there is a decent chance that one or more companies in the portfolio will seek to go public this year, and also believe that several investments could be sold to strategics before the end of the year. MAC3 has invested over $860 million in 33 investments. The MAC3 portfolio is off to a great start and has several early winners and realizations in the portfolio that have allowed the portfolio to have no J-curve and to outperform the broader markets. Some of those early winners include Lineage Logistics, which is our global warehousing and logistics company that specializes in cold storage that we've talked about in the past, and Clean Sea Transport, which is a dual fuel clean product tanker company that maintains long-term contracts with the largest methanol producers and has already seen its mark written up to 1.7 times based on strong market comps for similar vessels. The fund also co-invested in a California grocery store operator that our sponsor partner has been able to quickly turn around following years of under management and has already seen the investment written up to more than a 5 times multiple with upside potential. PE1 also has a $53 million commitment to our co-investment opportunities fund, GCF2, which, as you likely remember, targets middle market buyout codes. The portfolio currently includes 19 investments, and it's well diversified by industry, geography, vintage year, and sponsor. The portfolio has had 4 realizations and 4 partial realizations to date, which have generated a 2.6 times return to the fund. GCF has already returned more than 50% of investors' capital. And the remaining investments in the portfolio are performing quite well, with no investments marked below cost. All of this is helping to drive a healthy 32% IRR and a 2 times net return to PE1 for GCF2. Despite the challenging economic conditions in 2022, GCF saw its multiple actually increase modestly over the course of the year. 9 of the 19 remaining investments are currently expected to be marked above a 2 times multiple once our Q1 marks are finalized, and the fund is first quartile from an IRR and a multiple basis. One of the investments that is driving this is an investment in a company called Inifis, which I discussed during the last webinar. Inifis is a US-based leading producer of phosphate and non-phosphate ingredients. They're using consumer goods and industrial products. The company is a market leader, and phosphate demand has been incredibly stable over the last 20 years. The investment is currently marked above a 4x. And we believe there is a good chance the investment will be sold at some point in the next 6 to 9 months. Another investment, and this one actually happens to be both in GCF and in MAC, is a company called Advisor Group. It's one of the largest networks of independent wealth management firms in the United States, with more than 10,000 financial professionals. That company provides financial advisors with things like technology support, securities processing, regulatory and compliance support. They actually do not provide any financial advice. Since our entry back in the summer of 2019, the platform has made a number of accretive acquisitions and realized significant synergies. They also have a cash sweep business that has significantly benefited from the recent rate hikes and more than made up for a modest asset decline in 2022 for the advisors. Pro forma EBITDA has tripled since our entry, and the investment is expected to be marked at well over 3 times once our Q1 marks are finalized. P1 also made its first commitment to GCF3 last summer, committing $22 million to the fund at the end of June. The fund has already made 6 investments along 6 different sponsors. Although it is very early in the investment period, we are pleased with the level of diversification within the fund and the quality of the assets. The equity fund sleeve is comprised of PE1 secondary transactions and primaries. For the secondaries portion of the portfolio, as a reminder, we generally target niche opportunities, hard-to-access managers who restrict secondary buyers to primary investors in their funds, with the idea that we have an information advantage through our primary investment relationships with those managers. P1 has committed $121 million to 7 secondary transactions. $64 million was committed to GCF3, which is an implementation tool that we use to provide investors with a single point of entry to a portfolio of secondaries. The fund has already closed on 20 transactions, 15 of which were executed in 2022. So it was a busy last year, and after seeing many more GP-led secondaries in 2021 and the first half of 2022, we saw a nice return of traditional LP secondaries, completing 4 in the month of December alone. In those 4 deals, which involved 8 underlying funds, were purchased at estimated discounts of between 15 and 24%. Nice pricing that provides the portfolio with an immediate pop when we get our first PCAPs. We expect more of these types of transactions at attractive discounts the longer the current economic downturn persists, as many institutional investors have become overallocated to PE due to declines in their public market books or will otherwise require liquidity, which will make them forced sellers and create a really nice opportunity set for PE1. GSF is already performing nicely, generating a mid-teens net IRR to PE1. We've also committed $57 million to 6 standalone secondary transactions. They provided PE with significant vintage year diversification. They have funds ranging from 2003 to 2019 and early net returns of 73% and a 1.9 times multiple. This is still being driven by the strong returns generated by Project Rambler, which involved a $41 million commitment to a portfolio of 35 middle market buyout funds. That investment continues to outperform our underwriting expectations. It's generating more than a 2.4 times net return to PE1 to date and has already distributed 125% of the capital we invested in the deal. Within our PE primary sleeve, we've made commitments of over $93 million to 15 primaries, which includes 11 middle market buyout funds, 2 growth funds, and 2 special situations funds from 5 different vintages. While it is still quite early for most of the primaries we have committed to still having just under 50% of their capital to deploy in a market that we believe should create a rich opportunity set, we are pleased with the early returns, with funds generating a 19% net IRR and a 1.3 times net multiple to PE1 as of the end of April. We have also seen a nice uptick in investment activity within the primaries, with our funds deploying around 13% of our total primary invested capital within the last 6 months. And we did begin, as Fred mentioned, executing on our private credit strategy for PE1 last year, and we've seen a number of great investment opportunities. Portfolio contains a number of senior credit positions that continue to generate yield. We've executed 10 investments in the sleeve of the portfolio, realizing 2, and the portfolio investments are collectively generating a pretty attractive 11.5% estimated current yield. And then finally, we closed on our first investment in the tactical sleeve late last year after several deals fell away during diligence. This investment involved the secondary purchase of 4 middle market buyout funds and 1 distressed debt fund. The 5 funds, which were purchased at an aggregate estimated discounted close of 20%, have exposure to over 60 companies, and the portfolio includes a really nice blend of potential near-term distributions over the next 12 to 18 months, as well as potential value uplift from companies expected to be held for the next 3 to 5 years. So slide 15 lays out the 10 largest positions in the portfolio, and it does look quite familiar to what we presented at our last webinar, with Bolt Technology being the only newcomer, replacing Alcogen, which has fallen to number 12, even though it is still generating a return in excess of 2 times. Lineage leapfrogged Gainwell to become the largest position in the P1 portfolio at still a modest 4.6% of NAV after raising capital at a premium late last year, which resulted in a nice markup of the position. The company continues to win new business, manage pricing to protect their margin in an inflationary environment, and add minimum volume guarantees to their contracts. Lineage believes there are still opportunities to improve and has taken steps to convert more temporary labor into permanent team members, which should help increase both productivity and operational stability. We believe an IPO is a real possibility for this company in the next 6 to 12 months. The second company listed, Gainwell, they provide technology solutions that aid in the administration and operations of health programs throughout the U.S. They facilitate things like claims processing and recipient eligibility management. Since our investment in October of 2020, both revenue and EBITDA have increased substantially. And although Gainwell did see its performance decline modestly this quarter due to a slight decline in LTM EBITDA, the investment is still marked above a 2.5x. Performance is also what has driven the size of investments like SpaceX to the top of the list. The company has become more valuable through the pandemic and recent Russia-Ukraine conflict as it launched more payloads, not only than any other company in the world, but also any country in the world. The company's satellite internet service, Starlink, now has over 1 million subscribers, and the company is free cash flow positive. Just touch on a couple more here. Bolt, which I mentioned at the top, they're a leading rideshare provider in Europe and Africa. They've seen excellent growth driven by continued strength in rideshare and additional delivery services. The company became profitable in the second half of 2022, though it was marked down in 2022 to reflect declines in public market comps that impacted many companies, particularly companies in the growth stage of development. That said, the investment is currently marked above a 2x, so it's still performing quite well for the PE1 portfolio. Instacart had a challenging 2022 with several markdowns during the year due in part to compression in public market comps, which comps are particularly impactful to a company that is eyeing an IPO. We do continue to believe that the company's current market is conservative given its positive free cash flow and continued annual growth. Furthermore, given our very attractive entry point, we expect a successful outcome on our investment in Instacart, even if it is realized at the low end of our forward-looking expectations. And then finally, last but not least, is J&T Express, which is the largest independent express delivery company in Southeast Asia. Superior funding and operational capabilities have enabled them to become a leader in what is really a defensive delivery market. And the secular growth in e-commerce across developing economies should drive the company's success. They're projecting meaningful revenue growth in both 2023 and 2024, driven by an expected increase in order volume in China and the Southeast Asia markets and an improved margin profile of the business. We would not be surprised to see the company pursue an IPO in the not too distant future. So all of this activity within the portfolio has led to strong cumulative returns since inception. PE1 has generated annualized returns of 11.3% since inception as of 30 April, which is right in the middle of the target return that was established for the fund at launch, which we do feel pretty good about, particularly given the challenging market conditions we've had both during the pandemic and over the course of the last year. We also think that the performance to date is made even more impressive by the fact that we were still ramping in the portfolio over the last couple of years, which means that the actual PE returns are well in excess of the returns reflected here. So I'll stop now and open this up to questions.
Thanks, Corey and Fred. That was a really fantastic update. We do have some questions that have come through. So firstly, for you, Corey, you referred to PCAPs. Can you elaborate on that a little?
So in a secondary transaction, when you purchase at a discount, you're buying it at it's typically for us lately somewhere in a 15 to 20% range. And so when you become a limited partner in that fund after you bought the interest and you receive your first partner capital account statement, so you are now a limited partner in the fund, you immediately write it up by the amount of the discount that was inherited the purchase price that you had. So in a situation of the tactical investment that I mentioned at the end, where we bought those interests at a 20% discount immediately after when we received our first partner capital account statements, which will be as of March 31, which flows through into PE1's marks several months later. Overall, you will get an immediate pop of another 20% with respect to those positions. So one of the nice things that that secondaries do in a portfolio is give you that immediate pop from an IRR perspective and help get us some earlier returns.
Awesome, thank you. A few of the other questions I can kind of group. There's quite a few questions around risk, which I think makes sense in the current investment environment. So you sort of touched on this at the start, Fred, but with increasing investment risk across most markets and regions, what changes or enhancements has the team made, if any, to mitigate these potential risks? And what changes are you seeing in the way that managers on the platform assess opportunities?
Yeah, I think it's an interesting question. I don't think we've changed very much. And the reason I don't think we've changed very much is that we probably were wrong for several years, where even before COVID, we thought we were late cycle. So we were kind of in a defensive posture in terms of the way we were evaluating companies, the types of companies we were evaluating. If you looked at our kind of underwriting models from 2018 and 2019, what you would have seen is that we had kind of recession cases built in, and we had cases with interest rates going up kind of built in. And so being wrong actually insulated us quite a bit during the cycle, meaning it ended up being kind of right, but delayed and for the wrong reason, if you know what I mean, which I still think is wrong, but nonetheless, it was sort of defensive and protective what we're doing. I do think you see a change in terms of the underlying managers and what some of the activity is. So there, I don't think people really were kind of anticipating a recession. I don't think people were really appropriately modeling or mindful of the likelihood of increase in cost of leverage, as they were doing new deals or as well as on some of the existing deals when they would get refinanced. And at this point, I think most of the market has come to a place where they understand that. And you're starting to see a little bit of a shakeout, though, between the managers who are really, really high quality and they could take a business and they know how to get through a difficult market and they know how to deal with increased financing costs and they can do very well, and those who can't. And so my hope is that, and I think largely this will be true, that we're better at finding those managers than most people, and we have had relationships with them that are often a decade or more long to be able to see that through the cycle, and so that'll serve us pretty well. And I'm sure there'll be some learnings in that too, where we'll look at who didn't do very well, and then maybe those will be relationships that don't continue.
That makes sense. Thank you. And then also on the theme of risk, obviously, private equity is very important in terms of portfolio diversification. Is that more important in today's environment, do you think?
It's a good question. I think private equity, assuming you had all the options available to you, which traditionally kind of retail on-market investors have not had that as an option, should have private equity in their portfolio. Meaning, whether it's a risky environment, an environment that feels benign, et cetera. I mean, private equity is so fundamental. There are the total market cap and market value of private enterprises far exceeds public enterprises, and you're just missing a huge segment of business and the economy if you're not a participant. And so I think everybody should have kind of access to it. I think in this type of environment, what you're going to see is that the private equity sponsors who have control can often do things or react quicker in negative scenarios than some public management teams do, and maybe aren't quite as aligned, if that makes sense. But I actually believe fundamentally people should have both at all times. I think it's just, if you want to be at the right place on the efficient frontier and have a good portfolio construction, I think it should just be part of people's portfolios during it. Now, sizing, we could all debate. Probably everybody's underinvested in private equity is the truth, including institutions. But I think retail is even more underinvested, truthfully, in private equity.
And that makes sense also. Corey, this one is for you, and also just in the theme, I guess, of risk management. Can you explain the approach to portfolio diversification and how you're sort of managing that across the investment portfolio at the moment?
Yes, certainly. So through the way we put our portfolios together, we do seek to mitigate risk through diversification. Although we try to make sure we're not diluting the overall risk-adjusted return profile of the portfolio. So we try to diversify across a number of ways. So, for example, we always look for vintage year diversification, and I mentioned that a number of times earlier on. It's important since market conditions can greatly impact the success of a fund or an investment from a particular vintage year. So having that broad vintage year diversification can help mitigate some downside risk. Geographic diversification in terms of portfolio company location and currency exposure can lower the overall risk of a portfolio by decreasing the correlation between investments. You want to invest across multiple strategies because that improves the portfolio's risk return profile and can be used to manage pacing and exposures. And you do want to include an appropriate mix of different sponsors because overexposure to a single manager can have really bad effects if the manager or the targeted strategy runs into problems. So, and turning back to the risk side of it, given the long-term nature of private equity investments and the somewhat limited options you have to liquidate an investment after it has been made, you really have to use robust risk analysis and evaluation during the investment underwriting and portfolio construction process. Right. So evaluating and mitigating risk is a key component of our underwriting process. And so in addition to evaluating just the merits of an investment, we also look to make sure that say the sponsor's investment process and their risk management practices are very robust and well defined. We want to make sure that their team is got the right people with good complementary skill sets, and they're appropriately incentivized to stay, because if you have people start to leave, it can be very disastrous for a particular strategy or fund. And you also want to make sure that the interests of the sponsors, portfolio company management, and investors are appropriately aligned. So we ultimately try to make private equity investments that we believe provide appropriate downside risk mitigation and an appropriate risk return profile for the respective sub-asset classes. And we believe that our approach to portfolio construction and our focus on that downside risk mitigation has really helped investment performance for our clients through changing environments and different market cycles.
Cool, thank you. And then sort of pivoting, I guess, away from the concerns around risk in the environment at the moment, but sort of looking through, obviously private equity is a long-term hold in a portfolio. So are there any particular industry sectors that you think are really opportunistic in the 5-year plus kind of time frame at the moment?
Yeah, listen, I think obviously it will depend to some extent upon where we are in a particular market cycle. As Fred had mentioned earlier, today things like U.S. healthcare and consumer staples continue to be interesting given where we are in the current market cycle. I think that IT continues to be interesting no matter where you are, but we will typically attack it in different ways. In a more recessionary environment, we're going to look at IT that is more efficiency oriented, right? As companies are looking to slash costs and be more efficient. And as we come out of this recessionary period and move into a more of a growth period, you look more towards IT that's focused in that sector, in that direction, more towards growth.
Thank you. We've got time for probably a couple more questions. So maybe Fred, so, cutting from risks and opportunities, this is just, I guess, around the due diligence on potential investments in the portfolio. There's a couple of sort of questions in this theme. Fred, how do you, and it's sort of leading, I guess, from Corey's answer, but how do you evaluate potential investment opportunities in terms of their growth potential and risk profile?
Well, I mean, it starts from different things. So first, where we're working alongside a sponsor who should be an expert in their space. They should have done full due diligence on the people, the process, the businesses, all the assets, et cetera. And we have full access to all that information, right? So you start a little bit, I'll use a baseball analogy, which I'm not sure it'll work for an Australian audience, but you sort of start on third base, right? And so, the running home is not that, you don't have that far to go. And then we have a full team of people who do a second level of diligence that could have been standalone diligence, if that made sense, meaning it was enough to be standalone diligence. And you're doing the same work, you're redoing the same work, you're looking for holes, and then you're layering on a bunch of other things on top of what they're doing, including, a different industry approach. We have an advantage because we sit in a place where we're sort of at a perch that's a little bit higher level than most people. We see every deal, right? So we see every sponsor in every space and every competitor and every deal, and we can compare across, which allows us to sort of triangulate, some of those metrics. So things like a growth rate, there's always an opinion, right? You always have an opinion about how well is a business going to perform, how well is a management team going to perform, how well is a sponsor going to perform. We're able to sort of rationalize and I think be a little bit more successful at predicting a realistic band of those outcomes because we've seen everything in that industry, if that makes sense. So we're not going to have like one IT provider to a Medicare healthcare company in the US. And then the next day, we're going to have a different sponsor who has twice the growth rate for the exact type of business. That's not going to happen to us because we will have seen both and we'll be able to sort of make sure that parameter is appropriate. So I think that triangulation process actually helps. And then, largely there's a lot of judgment. We have great people in our team. The sponsors have great people on their team. They're experienced at doing this. It by no means that we're always going to be right. We just try and be a little bit more right than everyone else to produce some alpha in excess of what's available in the market. So, but I think it's truthfully, it's that access to extra information and market perspective. It makes us look a lot smarter than we are, because you have access to information other people don't have. It's easier to get those judgments to be correct.
I think that's obviously one of the beauties of the asset class. One more question, just leading back, you were talking about the efficient frontier before. So we have the question, to quantify the advantage of private equity, do you ever measure the correlation coefficient of the fund compared to, say, an index? The person's mentioned the All Ords, but probably a more appropriate one might be the MSCI for PE1.
Yeah, it's a good question. I'd be interested if Corey has a perspective. We don't really. And the reason we don't, we're focused on the underlying assets. And we're focused on the underlying kind of 400 or 500 companies that are going to be part of the portfolio. We know what the trading value and the correlation of those assets are, which is going to be low and it's going to sit well in people's portfolio. There's obviously a prism on top of that, which is how does the trust perform, in terms of premium to NAV, discount to NAV, trading dynamics, liquidity, that I don't think Corey or I would profess to be the experts on. We've largely kind of defer to kind of Pengana and the different market participants who are using it as a tool, rather than ourselves. We have been proud of the fact that we've been able to continue to deliver on the NAV, over that period of time, because our view fundamentally is if we can deliver, quality multiple, quality IRR, solid returns and yield, in line with a mid-teens plus target, over a period of time across our portfolio, the NAV will gravitate towards that value. And that will definitely deliver in people's portfolio, whether they consumed it in a listed vehicle with a slightly different volatility profile or correlation profile, they'll largely get the same impact and will have the same effect in the portfolio. And so I think that's really where we spend most of our time, rather than thinking about where the vehicle's trading, to be honest. I'll leave that to you, Melissa, and the folks at Pengana. You can all answer everybody's questions about where the vehicle's trading.
Cool. Thank you so much. I think that's all we have time for now. If you have asked a question and we haven't got back to you, or you do have any questions that you'd like to send through, we welcome those. I just want to say a big thanks to Fred and Corey. I personally get so much out of these updates. So, thank you so much for your time today. I guess one of my key takeouts is, like any sort of asset class at the moment, caution will be rewarded. And just making sure that you're invested in sort of robust companies with strong cash flows, which obviously GCM do. One other thing to note, not forgetting that the trust does target a semi-annual distribution of 4%. So the next distribution will be in June also. But, thanks again for your time, Corey and Fred. Thank you to everyone that took the time to dial in, and have an awesome day.